Hello students, welcome to another video of Upskilling Commerce series. In this lecture, we will discuss about basics of GST. So, Goods and Service Tax is India's modern indirect tax system introduced on 1st July 2017 to simplify and unify the country's tax structure. Earlier, people and businesses had to deal with multiple taxes such as VAT, excise duty and service tax, which often overlapped and caused confusion. GST replaced all these with a single transparent system following the idea of one nation, one tax. It is a destination-based tax, meaning it is collected where goods or services are finally consumed. GST is charged at every stage of the supply chain, but businesses can claim credit through the input tax credit mechanism, which prevents double taxation. In everyday life, GST is present when we shop for clothes, dine at a restaurant, book travel online, or pay for digital subscriptions, making it a tax system that directly touches both consumers and businesses. So, why GST replaced other taxes in India? Before GST, India's tax system had a fragmented structure where every state had its own set of rules, rates, and compliances. A truck carrying goods across states often had to pay multiple taxes and face checkpoints, leading to delays and higher logistics cost. For businesses, this meant spending more time and money on compliance instead of focusing on growth. Consumers also indirectly bore this burden because the cost of goods and services went up. GST was introduced to streamline the entire tax process by creating a common national market, removing barriers between states and allowing businesses to move goods and services more freely. It also brought in a technology-driven system of e-filing, online payments and e-invoicing, reducing manual paperwork and corruption. Another key reason was to increase tax compliance and widen the tax base, as GST uses input tax credit and invoice matching to ensure transparency. Ultimately, GST aims to make taxation simpler, improve competitiveness, and align India with international best practices where most developed countries already follow a similar VAT or GST model. Now let's see the key features of GST. First is one nation, one tax. It means that the goods and service tax has replaced multiple indirect taxes that were earlier imposed separately by the center and the states, such as excise duty, service tax, VAT, octroi, and entry tax. Under GST, the same set of tax laws, rates, and procedures apply uniformly across the country, ensuring that businesses and consumers face a single, transparent tax structure regardless of location. This has removed state-level barriers, reduced double taxation, and created a common national market where goods and services can move freely, truly bringing India under one unified tax system. The next is destination-based tax. It means that the tax revenue goes to the state where the goods or services are consumed, not where they are produced or manufactured. For example, if a manufacturer in Maharashtra sells goods to a customer in Delhi, the GST collected will go to Delhi because it is the destination state or the consuming state, and Maharashtra is the origin or the producing state. This system ensures fairness as the benefit of tax goes to the state where the actual consumption happens, aligning GST with the principle of taxing at the point of use. Next is multiple slab rates. Under GST, India follows a multiple slab rate structure instead of a single uniform tax rate. This system was designed to keep essential goods affordable while ensuring higher taxes on luxury and non-essential items. For example, basic necessities such as milk, fruits, vegetables, and books are either exempt or taxed at 0%, while goods of common use like edible oil, medicines, and transport services fall under the 5% slab. The 12 and 18% slabs cover processed foods, consumer goods, and most services, whereas luxury items and sin goods such as high-end cars, aerated drinks, and tobacco attract the highest slab of 28%, sometimes with an additional cess. This structure balances consumer welfare with revenue generation for the government. Next is comprehensive coverage. It means that it applies to almost all goods and services in India, making it one of the broadest indirect tax system. Before GST, different taxes applied separately to goods and services, creating complexity. GST merged them into a single system, ensuring uniform treatment for both. Only a few items are kept outside its scope, such as alcohol for human consumption and certain petroleum products. By covering nearly all sectors of the economy, GST brings transparency, reduces confusion, and makes taxation more efficient and business friendly. Next is input tax credit. It is one of the most important features of GST. It means that a business can reduce the tax it has to pay on its sales by the amount of tax already paid on its purchase. For example, if a manufacturer pays GST on raw materials while buying them and later collects GST on selling the finished product, the tax already paid on inputs can be deducted. This ensures that GST is levied only on the value added at each stage of supply, not repeatedly on the entire value. ITC thus removes the cascading effect of tax on tax, making goods and services cheaper and the tax system more efficient. Now let's discuss types of GST in India. The first is CGST, which is known as Central Goods and Service Tax. So CGST is collected by the central government and is applied on intra-state transactions. That is, when goods or services are supplied within the same state along with SGST or UTGST. The revenue generated from CGST goes to the central government, while SGST or UTGST goes to the respective state or union territory. Both taxes work together to ensure an equal sharing of revenue between the center and the state. For example, when goods are sold within Maharashtra, CGST and SGST are both charged on the same transaction. The next is SGST. It is also known as State Goods and Service Tax. So SGST is collected by the state government and is levied on the intrastate supply of goods and services, meaning transactions that take place within the same state. The revenue from SGST goes directly to the respective state government, helping it fund its development and administrative activities. SGST works in coordination with CGST for intrastate supplies to ensure fair revenue sharing between the center and the state. For example, when goods are sold from Karnataka to a customer within Karnataka, both SGST and CGST are charged on the same transaction. The next is UTGST, which is also known as Union Territory Goods and Service Tax. So UTGST is similar to SGST but is levied in union territories without legislatures such as Chandigarh and the Andaman and Nicobar Islands. It is collected by the Union Territory Administration and applied on intra-UT supply of goods and services. UTGST works alongside CGST to ensure that both the center and the Union Territory share revenue from transactions within the territory. For example, when goods are sold within Chandigarh, both CGST and UTGST are charged on the same transaction. And the next is IGST, which is also known as Integrated Goods and Service Tax. So IGST is levied on interstate transactions involving the supply of goods or services between two states or union territories as well as on imports into India. It is collected by the central government, which then distributes the revenue between the center and the destination state where the goods or services are consumed. IGST ensures a seamless flow of input tax credit across state boundaries, promoting a unified national market. For example, when goods are sold from Delhi to Maharashtra, IGST is charged on the transaction. Who needs to register for GST? Well, any business in India whose turnover exceeds the prescribed threshold limit must register for GST. Let's discuss this in detail. For goods suppliers, the limit is rupees 40 lakh annually and rupees 20 lakh for certain special category states like Arunachal Pradesh, Assam, Himachal Pradesh, Meghalaya, Mizoram, Nagaland, Sikkim, Tripura, Jammu and Kashmir and Ladakh. For service providers, it is 20 lakh annually and rupees 10 lakh in special category states as mentioned earlier. Suppliers who are engaged in interstate supplies must register regardless of turnover. Registration is also mandatory for e-commerce operators like Amazon, Zomato, MakeMyTrip, Uber, etc. Casual taxable persons. Casual taxable person is someone who occasionally supplies goods or services in a state where they do not have a fixed place of business, like a company from Maharashtra setting up a temporary stall at an exhibition in Delhi. Next is non-resident taxable person. He is a foreign entity or individual supplying goods or services in India without a fixed place of business here, like an overseas company providing consultancy or online services to Indian clients. Next is agent of suppliers. An agent of a supplier is a person or entity who receives goods or services on behalf of another supplier and may also arrange for their sale of supply. Essentially, the agent does not own the goods but facilitates or acts as an intermediary for the suppliers. Next is input service distributors. Is a business or office of a business that receives invoices for input services like services used for business operations and distributes the input tax credit to its branches or units that are registered in different states. Essentially, an ISD does not consume the service itself but passes on the credit to other units of the same company. While registering on the GST portal, there is an option to indicate whether the business will act as an ISD. You need to select yes if the central office or head office will distribute input tax credit to its branches. Next is businesses under reverse charge. Normally, the supplier of goods or services pay GST. Under reverse charge, the recipient of goods and services is responsible to pay GST instead of the supplier. In case of goods, RCM is applicable where supplier may not be registered or is unorganized. RCM is applicable on services notified under GST like legal services from an advocate, sponsorship services, goods transport agency services, services provided by an insurance agent, services from a director of a company, etc. Even small businesses below the threshold can opt for voluntary registration to claim input tax credit and enhance business credibility. Now let's talk about composition scheme. When a person applies for GST registration, they can choose to be registered as a regular taxpayer or to be registered in composition scheme. The composition scheme under GST is a simplified taxation system meant for small taxpayers to reduce their compliance burden. It allows eligible businesses to pay tax at a fixed percentage of their turnover instead of maintaining detailed records and filing multiple returns. This scheme is available to registered persons whose aggregate turnover in the previous financial year does not exceed 1 crore 50 lakhs and rupees 75 lakh for some northeastern and hilly states, and who are engaged in supplying goods or restaurant services, but excluding those restaurants that serve alcohol. However, it is not available to businesses making interstate supplies, supplying goods through e-commerce operators, providing services other than restaurant services, manufacturing notified goods like ice cream, pan masala or tobacco, or to casual and non-resident taxable persons. Under this scheme, manufacturers and traders pay GST at 1% of turnover, restaurants pay at 5%, and certain service providers under special notification at 6%. Composition taxpayers cannot collect tax from customers or claim input tax credit and must display the words composition taxable person on their invoices and premises also. They are required to file quarterly returns in form CMP08 and an annual return in GSTR4. While the scheme offers simplicity and lower tax liability, It also comes with limitations such as no ITC, restriction on interstate sales, and prohibition on selling through e-commerce platforms, making it suitable mainly for small local businesses. You should choose regular taxpayer registration under GST when your business needs more flexibility, wants to claim input tax credit, or is engaged in activities not allowed under the composition scheme. A regular taxpayer can make both interstate and intrastate supplies, sell through e-commerce platforms, and provide any type of goods or services without restrictions. This type of registration is suitable for medium to large businesses or those with a turnover exceeding 1.5 crore and 75 lakh in special category states. It is also ideal for businesses that purchase from other registered suppliers and wish to claim credit for the GST paid on their inputs, expenses, and capital goods, which helps reduce overall tax liability. However, a regular taxpayer has to maintain detailed records, issue proper tax invoices, collect GST from customers, and file monthly or quarterly returns as per the QRMP or regular filing system. Next, we will talk about reverse charge mechanism. RCM under GST is a system in which the responsibility of paying tax shifts from the supplier to the recipient of goods or services. It is used by the government in situations where the supplier is unregistered, difficult to track, or belongs to a sector where tax leakage is common. Under RCM, the recipient must pay GST directly to the government instead of the supplier, charging it on the invoice. RCM applies in several notified cases such as legal services received from advocates, services provided by a goods transport agency, sponsorship services, and certain supplies made by government departments. It also applies on the import of services where the Indian recipient must pay IGST under RCM. The tax paid under RCM must always be paid in cash. That means ITC cannot be used to discharge this liability. However, once the tax is paid, the recipient is eligible to claim input tax credit on the same, provided the goods or services are used for businesses and ITC is not blocked under law. RCM transactions must also be reported correctly in GST returns like GSTR 3B. Overall, RCM helps control tax evasion, improves compliance, and ensures proper tax collection in unorganized or high-risk sectors. GST is a multi-rate tax system. Not all goods and services are taxed equally. So let's see different tax rates in the GST structure. First is 0%, which is exempt. Basic necessities are exempt to keep essential commodities affordable. Some examples are fresh vegetables, milk, eggs, salt, unbranded cereals, books, etc. The next rate is 5%. It is charged on essential items and services but not completely exempt, so small revenue is collected. Some examples are tea, sugar, spices, metro transport, and rail transport. Next rate is 12%. It is a standard rate for most goods and services, balancing revenue with affordability. Some examples are processed foods, fruit juices, jams, business class hotels, mobile phones, etc. Next rate is 18%. It is also a standard rate for most goods and services, balancing revenue with affordability. Some examples are branded clothes, air conditioners, refrigerators, telecom services, insurance, non-AC restaurants, etc. And the last one is 28%. It is charged on luxury and sin goods to discourage overconsumption and raise higher revenue. For example, luxury cars, aerated drinks, tobacco, 5-star hotels, etc. Now let's talk about HSN code and SAC code. HSN, which stands for Harmonized System of Nomenclature, are used in GST to classify goods systematically, ensuring the correct tax rate is applied. Each product has a unique code ranging from 2 to 8 digits in India that identifies its category, subcategory, and specific type. Businesses mention HSN codes on invoices and in GST returns, which helps in proper tax calculation, compliance and tracking of goods. By using HSN codes, both the government and businesses can avoid confusion, apply GST accurately and maintain transparency in trade. The next is SAC, that stands for Service Accounting Code. It is similar to HSN but for services instead of goods. Under GST, every service is assigned a unique SAC code that identifies its type and category, helping apply the correct tax rate. Businesses provide SAC codes on invoices and in GST returns for the service they supply, ensuring proper tax calculation and compliance. For example, a consulting service might have SAC 9983 and attract GST 18%, while a transport service could have SAC 9965 with GST 5%. Using SAC codes, it brings transparency, avoids disputes, and helps both businesses and the government track service transactions accurately. Now let's see exemptions under GST. Exempt goods and services under GST refers to items on which no GST is charged, even though they fall within the scope of supply. The government exempts them to reduce the tax burden on essential items and support sectors like education, healthcare, agriculture, and public welfare. Exempt goods include fresh fruits and vegetables, unbranded food grains and flour, fresh milk, eggs, salt, books, raw agricultural produce, sanitary napkins, and certain traditional items like khadi and handloom fabrics. Services that are exempt from GST include healthcare services provided by hospitals and doctors, educational services by recognized institutions, public transportation such as metro and buses, services by charitable and religious trusts, agricultural services, and basic government services like the issuance of certificates. These exemptions ensure affordability of essential goods and services, protect socially important sectors, and help maintain equitable access for the public. Now let's discuss about e-way bill. An e-way bill, which is known as electronic way bill, is an online document generated on the GST portal to authorize the movement of goods from one place to another. It helps ensure compliance with GST laws and prevents tax evasion by tracking goods in transit. An e-way bill must be generated before the movement of goods if the value exceeds rupees 50,000, whether due to a supply, return or branch transfer, and it applies to both interstate and intrastate movements. The responsibility to generate the e-way bill lies with the supplier, recipient or transporter depending on who initiates the movement. To generate the bill, details such as invoice, delivery challan, transporter ID and vehicle number are entered on the portal, which then issues a unique e-way bill number and QR code. The validity of the bill depends on the distance, which is 1 day for every 100 km or part thereof, and can be extended in case of delays or vehicle breakdowns. The e-way bill system promotes transparency, reduces tax evasion, and facilitates smoother transport by eliminating check post delays. However, moving goods without a valid e-way bill can lead to detention or seizure of goods and vehicle and attract penalties equal to the tax amount or 10,000, whichever is higher. Now let's talk about e-invoicing. E-invoicing under GST is a digital system where registered businesses whose aggregate turnover is more than 5 crores must generate their invoices on the government notified portal called the Invoice Registration Portal. Instead of issuing normal invoices, businesses upload invoice details to the IRP, which verifies the data and issues a unique invoice reference number and a QR code. This digitally authenticated invoice becomes a valid GST invoice. E-invoicing does not mean generating the invoice on the GST portal. Businesses can continue using their existing billing or ERP software, but it must be integrated with the IRP. The system improves accuracy, prevents fake invoicing, enables real-time reporting of B2B transactions, and automatically populates GSTR1 and e-way bill data. E-invoicing is mandatory for businesses having turnover of 5 crores and above and aims to create transparency, reduce tax evasion, and simplify return filing by ensuring that the government's records match the supplier's actual invoices. Now let's see different types of returns under GST. The first is GSTR1. It is filed by suppliers of goods or services to report all outward supplies, which is sales, made during a month or a quarter. It is filed by suppliers of goods and services to report all outward supplies or sales made during a month or quarter. It contains details like invoice numbers, buyer details, and HSN and SAC codes. The government and the buyers use this information to verify input tax credit. Businesses with turnover above 1.5 crore file it monthly, while small taxpayers can file quarterly. For monthly filing, due date is 11th of the next month. Even if there are no sales, a nil return must be filed by the due date. Next is GSTR2A. It is an auto-generated view of all inward supplies which is purchase made by a taxpayer during a particular month. It is generated from the supplier's GSTR1 or GSTR5 and GSTR6 filings. GSTR2A is updated daily, so it reflects real-time data of what your suppliers have declared. It helps businesses reconcile their purchases and verify that the GST paid by suppliers matches the input tax credit they intend to claim. However, it is just a reference and not a return you file. Next is GSTR2B. It is also an auto-generated statement, but it is a fixed snapshot of eligible input tax credit for a particular month. Unlike GSTR2A, it is not updated daily. It is generated on the 14th of the next month and provides a reliable record of ITC that can be claimed in GSTR3B. It shows eligible, ineligible, and blocked ITC, helping taxpayers avoid mistakes when filing returns. GSTR2B is essentially a helpful tool for ITC reconciliation and accurate GST compliance. Next is GSTR3B. It is a monthly summary return where a taxpayer declares total outward supplies, inward supplies, input tax credit, and net GST payable. Unlike GSTR1, it doesn't list each invoice individually. It is mandatory for all registered taxpayers and must be filed by the 20th of the next month. Even if there are no outward or inward supplies, a nil GSTR3B must be filed by the due date. Next is GSTR4. It is for businesses registered under the composition scheme, which simplifies GST compliance by charging a fixed rate of tax on turnover. This return is filed quarterly and provides a summary of all sales, tax liability, and tax paid. Due date is 18th of the month following the end of the quarter. Even if there are no sales or purchases during the quarter, a nil GSTR4 must still be filed by the due date. Next is GSTR5. A non-resident taxable person who supply goods or services in India must file GSTR5 monthly. It contains details of outward supplies and tax paid, allowing the government to track taxes for businesses not based in India. Due date is 20th of the next month following the month for which the return is being filed. If there are no outward supplies in a month, a nil return must still be filed by the due date. The next return is GSTR6. Input service distributors like companies with multiple branches use GSTR6 to distribute the input tax credit among their branches. This return is filed monthly and ensures proper allocation of tax credits across the organization. Due date is 13th of the next month following the month for which the return is being filed. Even if there is no credit to distribute, a nil GSTR6 must be filed by the due date. The next is GSTR7. Businesses or government departments required to deduct TDS under GST file GSTR7. It reports the amount of TDS deducted from payments to suppliers. Filing is monthly and helps the government track tax collection by deductors. Due date is 10th of the next month following the month in which TDS was deducted. Even if no TDS was deducted in a month, a nil GSTR 7 must still be filed by the due date. The next is GSTR 8. E-commerce operators who collect TCS from sellers must file GSTR 8 monthly. It lists sales made through the platform and TCS collected, which is then credited to sellers' GST accounts. Due date is 10th of the next month following the month in which sales were made through the e-commerce platform. Even if no sales or TCS occurred in a month, a nil GSTR 8 must still be filed by the due date. The next is GSTR 9. It is an annual summary of all supplies, taxes paid and ITC claimed during the year. It reconciles monthly or quarterly returns and is filed once a year by regular taxpayers to ensure compliance and transparency. Due date is 31st December of the following financial year. Filing is mandatory for all regular taxpayers even if they have filed all monthly and quarterly returns. Certain categories like composition scheme taxpayers or nil return filers may have exemption or simpler filings. Next is GSTR 10. It is filed by taxpayers whose GST registration has been cancelled. It reports all transactions up to date of cancellation, ensuring proper closure of GST accounts. Due date is within 3 months from the date of cancellation of GST registration or the date of actual cancellation order, whichever is later. If there were no transactions, a nil GSTR 10 must still be filed within the due date. Now let's see impact of GST on businesses and consumers. The implementation of goods and service tax has transformed India's indirect tax system by unifying multiple state and central taxes into a single nationwide structure. For businesses, GST has simplified compliance, removed cascading of taxes, and promoted ease of doing business. By allowing seamless input tax credit across the supply chain, it has lowered overall costs and encouraged formalization of the economy. The digital filing and e-way bill system have increased transparency and efficiency, though initial challenges such as frequent changes in rules, system glitches, and compliance costs have tested smaller enterprises. Over time, GST has made interstate trade smoother, reduced logistic delays, and brought uniformity in tax administration. For consumers, GST has led to a more transparent pricing structure by displaying tax clearly on invoices and eliminating hidden taxes embedded in product prices. Many essential goods have become cheaper due to lower effective tax rates, though some services have seen a marginal increase in cost. Overall, GST has promoted accountability among businesses and improved government revenue collection, which in turn supports public spending and infrastructure development. Overall, it has strengthened India's economy by promoting efficiency, accountability, and uniformity across states. So that's all for GST. We will meet in another video with a new topic in the Upskilling Commerce series. Till then, thank you very much.